Hi, I'm Christine Giordano, Editor-in-Chief at Markets Group. My next guest is Mark Steed. He's Chief Investment Officer of one of the fastest growing funds in the world. He's heading Arizona's $21 billion Public Safety Personnel Retirement System, or PSPRS. And he's been supplementing his investment office's capabilities with artificial intelligence. In 2018, Mark started as CIO and quickly grew the $10 billion fund to the $21 billion that it is today, which made it, at the time, one of the fastest growing funds in the world. We're talking about 2021, 2022. Now, during this interview, we'll review what he's seeing, what are some case scenarios that artificial intelligence software can be used effectively, and challenges and risks around it, as well as best practices from his investor's perspective. Mark Steed was known early in his career as a rising star. He's known for his innovations and his focus on new and old solutions that work for portfolios. Welcome, Mark.
Thank you. Happy to be here.
Can we start from the top with the fundamentals of artificial intelligence?
Sure. Well, it's a pretty broad area, as you might suspect. I feel like there are terms that get thrown around in casual conversation. We'll say AI or machine learning or big data or predictive analytics, and these are all part of the same family. AI generally refers to models, and you have machine learning, which is really kind of the algorithm part of it. So you can't really have sort of like AI without the machine learning. And so it's just a subset. And that's where I think we and a lot of other groups spend their time. But generally, when we step back and we refer to kind of this space, we're talking really, I find about two or three different kinds of like fundamental models. We're talking about supervised learning. So that's where you kind of train a machine on a set of labels or data, and then you're asking it to kind of make accurate predictions about what that is. And so you're looking for it to basically make decisions off of a pretty well-known, well-defined sort of like causal relationship, right? And so an example of that would be like you show images of skin lesions, right? And you want it to sort of draw a conclusion as to which one of these lesions might be representative of cancer, and you have a whole library of data sets that you can kind of train it on, right? And you know what the labels look like, and kind of know what the output looks like. And those are supervised learning models, and that's kind of one big category of kind of this whole paradigm. And then you have like unsupervised learning models, and I think maybe with unsupervised learning, you're basically dealing with unlabeled data, if that makes sense. You've got input examples, and you don't really have kind of corresponding like outputs, right? So here's a bunch of information, and I don't really know what I'm looking for, and we want to discover sort of patterns or structures or relationship, and we want the model to kind of do that on its own. So the primary goal of unsupervised learning then is to really discover like the hidden patterns or structures, relationships and data that might not be obvious. So there are some kind of key differences, right? You've got supervised learning really kind of requires labeled data, right? And sort of a clear indication of like, what are you trying to solve for, right? And the really objective is mapping the inputs to the outputs. And that's really the goal. While like with I think unsupervised learning, what you're trying to do is discover patterns and structures in the data that you might not be able to recognize. So supervised learning traditionally is used for prediction tasks, and like the unsupervised learning is used for discovering kind of exploration tasks. And so those are really the kind of like the two main models I find that like where most people spend their time. And then you have like this other kind of category or a paradigm that's called deep learning. And deep learning really is just sort of you're working with just richer data sets, bigger data sets, but deep learning can be either used in supervised models or unsupervised models. So I think that's that's in my simplistic world, kind of how I lay it out.
And what are you seeing from within investment offices as far as its applications are concerned?
Well, it's an interesting question because oddly enough, for as much as everybody talks about it, it's really hard to figure out what everybody's doing with it, because I think my experience is a lot of the people that are talking about it don't really understand it all that well at a really technical level. They kind of describe what's going on, but they don't really want to describe it at a technical level because, frankly, in a lot of like most industries, you're dealing with executives and leaders who just weren't trained in the vernacular, right, of AI and predictive analytics. There's a heavy math, heavy stats, heavy computer programming. And these aren't really languages that a lot of leaders grew up learning, right? They're kind of business or marketing or finance. And so everybody's, trying to play catch up. And I think that is partly why it's been, I think, slow to kind of, why adoption has been slow is because you do need kind of executives to be able to speak the language and understand what's going on. So it's really kind of hard to tell what everybody's doing with it. Lots of groups are talking about it. And I mean, another reason why I think they're pretty quiet about it is because they consider these algorithms fairly proprietary. And there's, I think, some truth to that. But I think what people talk about generally, at least I think in finance institutional investing, are really kind of using both supervised and unsupervised models. And they're doing this to ideally make better decisions, right? So they're using a lot of it for like sort of predictive tasks. So, lots of like quantitative trading models using some of these supervised and unsupervised learning methods. And they're basically taking reams of information, right, about security prices and every other like things you can imagine, interest rates. They might be using geospatial data, and they're trying to feed all of this into a model that will tell them, hey, this security is attractive to buy or sell or go long or go short. And there's all sorts of models like that. And there's lots of them that are using it for what's called sentiment analysis. And so they're scanning, earnings calls, transcripts, things like that, and trying to figure out if the tone of the CEO or whoever is very, constructive, optimistic, or pessimistic, right? And ideally, you're trying to uncover something that may not be obvious to kind of the human eye. So I think like those are a lot of the main ways that we see groups using these models. It's just they're really kind of doing things that humans were trying to do before or were doing to various levels of success and trying to do them with more accuracy, and then identifying things that maybe a human might not catch and bringing those to the forefront. So that's why we see a combination of supervised and unsupervised learning. But it is hard a lot of times because of I just think that the asymmetry between sort of like leadership, the outward facing group, and the people building the models, and then just the proprietary nature of some of the models.
This stuff is fascinating to me. I remember a case study where they said, okay, they analyzed the earning reports, and the more flowery or bigger vocabulary the executive used, the worse the stock was going to do. I was curious to know, like, what in your sphere have you seen as perhaps some interesting case studies that have used?
Yeah, so I think there are case studies like that. I think one that I think is probably, it's not so much a particular case study, but an application maybe, and so I feel like this discipline is really expanding in the liquid markets, your stocks and your bonds, and that's because that information is fairly well structured. You have security prices, you've got a lot, history, you have long time series of security prices, and then you have a lot of other publicly available information that you can conveniently download in spreadsheets or you can access. And now groups are kind of moving towards like unstructured data, so stuff that is not in like an Excel spreadsheet or a CSV file, right? It's in a PDF or it's an image of something. You're tracking jets flying across the country, and you're tracking where the CEOs are flying to, right? And trying to glean some information from that. And I think that's it's becoming more and more like table stakes. Like if you're not doing that, and you're an active fund, then you're probably going to be behind, right? But I also at the same time, don't see a lot of value to it because more and more groups are doing that, and it's just becoming kind of one of the things that it's like personal hygiene, right? You shouldn't, you don't get really any points for doing it, but if you don't, it's really going to affect you. I think where the applications are getting really interesting is in the private markets, because I see a lot of opportunity for value there, and it's very it's hard to get information. The it's just not as accessible. It's often proprietary. People aren't posting. If you're a private equity fund, you're not posting a lot of information about your firm or your underlying companies on the web for people to access and analyze, right? If you're a private lender, same thing. And so I see more and more interest in applying some of these tools to the private markets, and they can be supervised or unsupervised. Effectively, they're trying to figure out what makes it, if you're a private equity company, what makes a better portfolio company investment, who are the candidates on your team who are probably better promotion candidates, what makes a good partner. And they're trying to be real sort of rigorous and structured in their way of thinking and trying to really systematize their logic. And I think those applications are pretty interesting.
Can you tell us some nitty-gritty secrets on what might make a good performer or characteristic?
A lot of the stuff is interesting. A lot of the stuff is really just kind of in beta at these firms. It's something that we have learned to incorporate in our own due diligence process when we're talking to GPs, because what we really want to see is commitment to this space and learning to be more rigorous and objective in the analysis. And I've said this a lot, that humans make models better, and models also make humans better. And so what we're trying to do is remove all the subjectivity to the extent that you can. You're never going to be able to remove it 100%. And because models can be wrong, you have to have sort of that human judgment piece, but humans can be wrong too, and we miss things. So you have to have sort of the model. So I think we see firms using this kind of in various ways, but it is also very particular to the firm. You might have, if you're a distressed debt investor, there might be a certain set of qualities that are better suited to that field than somebody who let's say does venture capital or middle market buyouts. And so what we look for are just groups that are starting to acknowledge this and moving in that direction towards understanding the data science, or having data scientists, or trying to improve kind of their own understanding and fluency in this space. So right now, I think we'd probably be a little uncomfortable if anyone just said, "Hey, we have this model, and we're just letting it run and tell us what to do, and we're just following it." That doesn't really make people very comfortable. But I think what we're seeing now and what we're doing, what other groups are doing, is we have our own human judgment. We're tracking that. We're getting good about that, and we're tracking our own decisions and the quality of those decisions. And then we're also kind of running models here and tracking those. And we're just going to kind of look over time to see, are we close, or was one of us right and wrong more often? And I think that's the sort of discipline you have to create. And I feel like that's, if we're looking at the old baseball analogy and we're like, well, are we in the second inning or the third inning? And I feel like we're just kind of getting dressed to go out onto the field. I really think we're very early stages here. So we don't see too much widespread adoption yet. Lots of groups looking at it and developing it.
And in your experience, what are some of the things that AI can pick up that a human cannot?
Yeah. So it's really interesting. So we all know that the AI can pick up things that humans can't. And so, maybe an example of this would be what's called like an isolation forest. So an isolation forest is like an unsupervised machine learning algorithm that's used for anomaly detection. And probably the most common application of that is credit card companies using something like this to identify, potential fraud, right? And so this kind of algorithm is really effective in just like identifying rare events or outliers in larger data sets. And the idea behind like an isolation forest is that like anomalies are kind of easier to isolate than normal data points, because they have like really unique characteristics that like distinguish them from the majority of the data. So if you think about asset management, this can be really interesting because I might want to find, if you're a public pension plan and you're wanting to only work with the best general partners, whether buyout funds or venture capital funds, you really want to find those groups that are going to be outliers. And just because they were one historically doesn't necessarily mean that they will be one going forward. But that again could be an input into the model, right? Past outperformance. But what you're trying to do is identify, hey, is this group, I want to just invest with groups that are in the top decile, or going to be in the top decile of their peer group. So I'm going to take all this data I have, right? And some of which I kind of have a sense, for the correlation, but there's a lot of stuff that I might not be thinking of, right? It might be the number of partners that they have, right? Or the partner to portfolio company ratio, or the salaries, or there's all these things that might be more indicative of an outlier than I think, right? And so you have these isolation forests. You can spit the data in, and it's basically going to kind of separate each data point and until it's kind of isolated all of them. And then it's basically, the thinking is like, if you think about all of these data points as like a branch growing, and they're each like a leaf on a branch, the ones that are closest to the trunk are probably the anomalies because you isolated them really, really quickly. And so this is like an example of where you can use machine learning to maybe enhance the manager selection process, right? And there's lots of other ways to do that, but that might be kind of one way that these models can maybe identify things that humans might miss, because we all sort of have a vague idea, right? And probably past performance it's better that you did well than didn't, because if you did well, then it's going to be easier for CEOs and management teams to want to bring you in as an investor if you're a private equity firm, or you're going to get your pick of the best candidates, right? If you've done well. So there is some persistence to that, but there are also some other things that might matter that investment teams aren't looking for. And I think that's an area where you could have an algorithm like this, where like an isolated forest that you would use to kind of supplement your own due diligence, and it might highlight some things that you weren't aware of. Now they have problems, like all of these models do, but this would be a way that I think one investment team could actually improve the underwriting process.
And what should you be careful not to do when using this?
So the problem with for example, like isolation forests, you need a pretty large data set, and that I think is a big gating item for a lot of investors, and certainly a lot of pension plans. Pension plans just aren't structured to be scraping just tons of data and storing it in a way that you can kind of use to build models. And so you do need huge data sets for a lot of both supervised and unsupervised learning. So you need to have these large data sets. And in this particular example, just this won't necessarily apply to all models, but all models have weaknesses, right? And I think that's what you have to be aware of. But also another problem with like the isolation trees is you really need the outliers to be unique. And so to the extent you've got a lot of randomness in the underlying data set, the characteristics that distinguish or that might predict future performance may not be they may just be fundamentally random, right? They may not be there. And so you do need there to be some kind of something exceptional, right, that a model can pick up. Otherwise, it's just gonna say, look, it's just random. There seems to be really no identifiable factor, which by itself is actually also revealed. I mean, that's also very helpful, because if you're an investment team and you just think, wow, okay, look, it's really, there's a lot of subjectivity in the underwriting process as it is. If you're a pension plan and you're looking at a private equity fund or a venture fund, right, you've got a lot of, on the one hand, on the other hand, kind of comments. And then if you have a model that's supporting, the model is kind of telling you, we don't have a lot of clarity here either, then that's useful. That's useful because it helps you also approach your own underwriting with a degree of skepticism, right? And in some worlds, I think it's more, it's just more appropriate to express uncertainty than it is to express certainty. But every model has weaknesses like that. And I think it's important to just be able to identify what they are. The risk for an investor, I think, is that a vendor could approach you, and a vendor could say, we use machine learning to help you make better decisions. And so if you want to make better decisions about underwriting private equity funds, well, then here you just feed all your data into this model. And we tell you, of all the funds you're looking at, we think this one's going to probably be the outperformer. And if you don't know, if you're not fluent as a group as to what the risks are of that model, you can make some bad decisions and really burn a lot of social capital. So I think it's important to really be aware of those.
And how do you tap out what the risks are?
Well, I think part of that is just understanding, like there's a handful of kind of shared issues, right? One is, so there are like knowledge of the specific models. If you're using a neural net, for example, right? Without having to explain like what a neural net is, you just need to know like there's a bunch of steps in the process, right? You have to you have the architecture, right? You've got an input layer and a hidden layer and an output layer, and just as an example, if you're a casual observer and somebody says, "Hey, we're using, uh, a neural network, and there's a neural network called like an MLP, and we're using an MLP, and we have an input layer, a hidden layer, and an output layer." And if you're sort of the casual observer, and you're out, you kind of ask that part of the question, that might be enough for you, right? But someone who's more trained on these models might say, "Well, like, how many hidden layers do you have? 4. Why 4? Why not 8? Why not 12?" Right? And then you have to know that the next step is for propagation. And then when you do that, you apply like an activation function. And that's to make, to introduce a level of nonlinearity to it. And when you do that, you can use what's called a sigmoid activation or a rectified linear unit activation. And both of those can have significant impact on the output. So without delving into the nuances of the model, you just have to know that they all have these idiosyncrasies, and they will create, they're more appropriate for certain use cases than others. And that's why I think as a group, you've got to be fairly fluent in, the pluses, the advantages and disadvantages of the individual model. So that's sort of like one. Two is people have to recognize that a lot of these models just sort of, especially if we're talking about like large language models now, just kind of lack a fundamental understanding of like the way the world works, right? That there's like a logic that's kind of missing. They're working strictly on probabilities, right? So if I ask, I did this one time, I asked ChatGPT to create like a biography, write my biography. And it said that I graduated from Harvard when I didn't. And it's because what it's doing is figuring out like probably, that there's words chief investment officer, in institutional management. And it was probably drawing the conclusion based on probabilities that I graduated from Harvard, which I didn't. But you could say maybe a safe bet if you didn't actually know, that might be a safe assumption. And so I think that's an issue with a lot of like large language models, that they just, lack that understanding. And we don't really have, in the grand scheme of things, enough data in most cases to make these models really robust. I think the industry recommendation is somewhere, you need like 1 million to 100 million, kind of observations to train, a neural network, have sort of like high confidence that it's going to yield robust results. And for a lot of investors, you don't have that kind of information. So I think that can cause some anomalies in the outputs.
Yeah, I think Mike Sedlis referred to one of these language models as saying you could have hay for breakfast.
Yeah. Yeah.
In my own experience with transcripts, it's actually put false words into people's mouths when I've asked it to transcribe, recordings.
Yeah.
So, and actually eliminated data from transcripts. So, to that point, I mean, it makes things so much easier. And there must be that temptation to always set it and forget it. But where do you decide how much to check over what it does? Because, I mean, if you're going to do the work anyway, it's going to be the same amount of time put in, whether, AI does it or you do it, whether or not you're checking over it thoroughly. So how do you decide?
So I think what you have to do is sort of start, you have to start somewhere. And if you're running a model, so I don't like recommend, cold turkey, hey, this is now going to be kind of automated. We're going to use, algorithms or whatever to handle this. I think you can identify tasks and say, look, here are some kind of low risk tasks, right? So for example, you might say, hey, we have, we get all these PDFs, we get quarterly statements from our private equity funds that we invest in. And what we'd really like to be able to do is pull a lot of the information that's in those PDFs about the underlying companies and pull those out and stick them into like a CSV file, right? And you can have somebody kind of look over that, but that's a fairly low risk function, from that standpoint. And that's, using something that's like a robotic process, and that's a kind of a subset of AI, but a little bit different because you're not running like algorithms, right? And, that's a fairly low risk task. And so I think as an entity, you can kind of start and say, well, what are all the things that we do? And what are the ones where if there was a mistake, it would be fairly low risk, right? And that's very much different than, making an investment decision, a purchase decision, right? And you could even say like, well, a sell decision might be less risky than a purchase because, if we have a false negative, for example, we sell something that maybe we shouldn't have, that's not as bad as investing in something that we shouldn't have, really, in the grand scheme of things, because all we have to do is worry about the things that we actually are invested in. So my recognition is to kind of look at like all the things that you do and to kind of put them on like a risk spectrum, where if this thing made a mistake, it would be very bad. Now, the important thing though, is that there are mistakes probably already happening with just the human involvement. So the question is like, well, how accurate do you expect the human to be versus how accurate do we expect the algorithm or the model to be? And I think that's kind of like part of the best practices is just say like, where's that trade-off, right? And this is something that Tesla does with their self-driving cars. They can say, hey, these self-driving cars can drive for so many million miles before they get into an accident. And by the way, here's how many millions of miles humans can drive before they get into an accident. It's a lot less. And so I think that's sort of the objective analysis, right? But there's also kind of the subjective piece, which is people just feel more comfortable if a human's looking at things. So even if the model is more accurate, you still need to have sort of a human looking at it, right? And that's why pilots, they are flying the plane mostly on autopilot, but you wouldn't feel great if there was no pilot in the cockpit, right? Even though their, perceived involvement might not be significant. So it's a bit of a moving target for each organization, but I think you have to kind of step back and say, well, what do we do? What are the high risk functions? What are the low risk ones? And if you can use AI to kind of streamline some of the low risk ones, I think that's just, it's low hanging fruit, and you can kind of build that culture and the fluency. And then I think with the high risk stuff, you have to kind of run that in incubation to just get a sense for, is it more accurate? At least as we're watching it, we're actually not going to use it. We're just going to kind of run it in training here. And then be real clear about what do we do sort of when we put it into practice live. And I think all that, like having that framework and understanding is really important.
So how did you learn so much about it? And do you have any advice for people who might want to also?
I just got really curious about it back at the end of 2008, on the back of the global financial crisis. I just thought, hey, there's got to be better ways to, make decisions absent, just tons of historical data. And, it was very much thinking about like the risk, how do you avoid losing a lot of money? And, we all have these models that are using historical data sets. But, the future is different and it's not always linear. And so what are the rules of the road? And that's just how I got interested. And I started looking around and doing some research. And, the more I started using models, I just started coding in Python and R, and, really just started, you kind of start with the linear stuff. So linear regression and logistical regressions, which kind of help you identify binary outputs, right? Good investment, bad investment, good employee, bad employee, whatever. And then, but that's assuming kind of linear relationships. And then I just started looking at things that were sort of nonlinear, right? And that's where you get into some of the like supervised and unsupervised learning and like neural nets and these random forests and things like that. And the great thing about it is there's just lots of tools out there online. Kaggle's a really good one. You've got all sorts of courses through Coursera and all these other online platforms that can kind of teach you coding. And I think you just have to approach it with an open mind and be flexible. And then I think what's really important if you're in a leadership position and, you want all your employees to broadly kind of come around to this, I think is kind of create a curriculum, for your team and encourage where you can or make it mandatory, right? That they sort of develop these skill sets. And, I think that the organizations that are really kind of front-footed about that will be better off in the future. They'll know when to apply these models. They'll know the risks of the models. And they'll understand that everything's going to have, there's mistakes everywhere. But I think you'll make fewer of them. And hopefully the good decisions will outweigh the bad decisions, right? If you're front-footed and clear-eyed about stuff like this.
Do you have any favorite data sets or points of comparison?
I don't really. I'm a big fan of, look, if you want to practice, you can practice, on a Kaggle or one of these other websites. They'll have like reams of like data and libraries you can go through and access, you can access like a lot of good economic data from the St. Louis Federal Reserve, but there's all sorts of libraries out there that you can access just to practice. And that's what I would recommend. Longer term, I think, organizations need to get really good. And this is what we're trying to work on right now. And that is, trying to wrangle your unstructured data. So we're swimming in just kind of PDFs, and there's a lot of information in those PDFs. And so we're about extracting all the information we can from those PDFs and putting those in a system that we can use to build algorithms off of. So I think building your own data sets is really important because you're trying to outperform peers or do kind of relatively better. You've got to be doing things differently than everybody else. And I think that involves having your own data and building your own algorithms. So yeah, I wish I had a better answer for that one, but I think the training data sets out there through some of these online, competitions is pretty good.
Fascinating. And as far as where are you going next with this? What are your plans?
Well, I think it's going to take us some time to kind of capture all the data that we want. The hard thing about data is, if you if you're investing in funds or even like direct positions, and you're trying to you're extracting all of the unstructured data and trying to make it structured so you can use it, but you're also kind of creating your own variables along the process. But all of that is assuming like now you're kind of looking backwards based on what happened, and you're saying, well, it'd be really great if we had had a variable for this thing, but that's not something you would have known at the time. And so in this process, we're trying to build out and expand our data, but we're also trying to be careful not to overfit, and where we can be very careful about, what information will we actually have known, so that as you're building algorithms to help support decisions, that they're as pure as they can be. But I think for us, we'll continue to kind of systematize a lot of our investment logic, and then we'll see where that goes. It goes from there. I'm not, I think a year from now, things will look a lot different than they do today. So you never know. But I think, wrangling all of our data is going to take us some time, and I suspect that's what we'll be at for the next year or two.
Sense. How big is your team, your investment team?
At any point in time, we have the investment management team, and it's about 13, 14 people. And we have an operations team, which also includes 2 data scientists, which is obviously important for what we're doing. And then we have 3 people in legal. So maybe 20, 22 people at any point in time.
And how many are trained in this?
Right now, it's myself and the 2 data scientists, and the team is coming up the curve pretty quickly.
Would you say it's added a certain amount to your fund, or is it just part of the whole?
Tough to say. Yeah. No, tough to say. It's a good suggestion in terms of being able to quantify like the value add. So right now, the way that decisions work at my shop is you have to be very specific about what your recommendation is. So if it's a manager, you have to say, look, this manager is going to outperform its benchmark by X% by within this period, 1 year or 2 years, and you have to say how confident you are that that's going to happen, 60%, 70%, and we catalog that, and we go back and review everyone's decisions to see for all of those decisions in which you were 70% confident, were you 70% right? And that's really important to us because that does a few things. It has a way of kind of, it's a more egalitarian approach to decision making. So whether you used a model to arrive at your conclusion or just your gut, it doesn't really matter, although you have to support the rationale one way or the other. And so what we have right now is we're tracking everybody. Some of them are more sort of qualitative in their decision making, and some of them are more sort of systematic, and they're using models to make forecasts. And we're tracking that, and it's going to take us I'd say a year or 2 longer before we have enough data to kind of start to see where our model's helping us, and where is our human intuition just better. And so I think it's tough to kind of quantify right now, but at least at the start, I thought we have a pretty good baseline. And it's fair. If people are allergic to models, that's okay. If people are allergic to others' sort of gut instincts, that's okay. Our goal is to get to truth. And in order to do that, you need to sort of debias that conversation and just track, well, who's being more accurate right now? And, we need to at least be able to kind of say that, and how much more accurate is, say, an algorithm versus a human. And that's, I think, an important first step. And then we can kind of get to, what do we think the impact is on the, on our AUM? Haven't gotten there yet. I don't think we have enough, big enough sample size to make that conclusion.
Thank you, Mark Steed, for joining us today. It's a changing world out there, and very happy to hear from you. Thank you for helping us kind of visualize the future. Are there any trends that we're forgetting about, or any key takeaways here?
No, I mean, the good thing is I think the industry is well covered at this point. There's lots of interest in it. Um, and I think look, with the advent of Anthropic and ChatGPT and some of these other tools, they're very robust. But I think people just have to be careful that they still have weaknesses. I think we're all aware of that, but we do have to fight against that evolutionary bias. To just be able to say like, hey, if we can explain something, we can kind of control it, and models make us feel like we can explain things, right? And so there is a bias to just sort of set it and forget it and follow these models because it's just makes us feel comfortable. But I think we all have to be pretty suspicious, and but I'm optimistic. I think these changes will be good for everybody, and I'm optimistic that we'll create the safeguards that we have to. But very exciting. There's some risks, but I think I think I'm optimistic for the future for sure.
Good to hear it. Thanks again.
No problem.